Hi there. So we are diving into the hedge, the short hedge, because we presented an example where you are a trader, you buy aluminum, you hedge aluminum, the prices go down. Remember, so since you have sold at the LME, you have the prices go down. When you buy back, you make some money at the LME to compensate with the money of your invoice, because your invoice will be issued at the lower price. You knew that. We also saw and explored the case when you buy aluminum, there's no fixing of your sale, so you go into the LME, you trade short hedge, but in this case the prices go up. Since you placed the short hedge, your invoice is going to be issued at a higher price, while your position at the LME is going to show a loss because you sold, you went short, and the prices went up. And this is because your goal was to lock in the profitability or the economics of your case, disregarding whether the price is going to go lower or whether the price is going to go higher. But we saw that if the prices are going higher, you are losing an opportunity of the upside. Yeah. So there is another instrument. We saw the short futures. So there is another instrument which is called put, which is the right to sell. Okay, so one thing will be boom, outright sell. It's you locking your economics. Alternatively, like the insurance of a car, you buy an insurance, which in our case we call it put. How, conceptually speaking, will the put work? It works as the insurance of your car. What does it mean? You pay a premium, you crash your car, and you get the compensation to repair it or the full value of the car. This is an insurance. So think for a moment of this insurance. So we said that you were buying aluminum at 2,500, correct? And you placed a short hedge, and we said 2,506 because there was a contango. Anyway, you were short. Instead of going short, you trade with your broker a put option. You buy a put option. It is an insurance. What is the protection? In this case, you have to fix the value of the insurance. Let's say that the value of the insurance is 2,500. Okay? So, and remember, your profit is the premiums differentials on the physical, right? But in this case, and in this example, you will buy the right to sell. You will buy a put. When you buy the right to sell, or you buy a put, or you, conceptually speaking, it's a protection, an insurance, you have one obligation, which is the obligation you have. Think. To pay a premium, which is the cost of the coverage. So now we assume that you have full protection, 2,500. What will be the incident? The prices to go up or the prices to go down? The incident will be that the prices go down. So you ring the bell of the insurance company, which as a matter of fact is the broker, and it's a matter of fact there is a due date to ring the bell, which is the first Wednesday of the month when this option expires. And that will be your last day to exercise your put. If the prices fall down to 2,000, you exercise your put. Yeah. So you have the compensation of the loss of value, and against that you pay a premium. But the interesting thing is, why would you buy a put instead of selling a future without any cost? Why? And this is exactly the opposite logic of an speculator. A speculator who buys a put and has no position, he has the right to sell, so he expects the market to go down more than the premium paid, period. That's a speculator. While the hedger who buys a put, he doesn't want to crash his car. He just buys it in case this incident of prices falling comes. So he will dream of never exercise it. And he will dream of the prices to go higher more than the premium paid. So in other words, he has the protection. There is a vision of, I expect the market to go, in this example, to 2,700, okay? So I pay the insurance just in case the prices fall down, but I would love to abandon them if the market goes to 2,700, expecting the higher price to compensate the cost of the premium, and that's it. The rest is the mechanics, the rest are the details. So again, this becomes complicated, a little bit more complicated. Sorry. But this is the characteristic of a put, which is the right to sell, and for a hedger, dreaming of never exercising it. To the opposite, to abandon it, and that the higher price would be higher than the cost of the premium, which may happen, may not. But in order to face such a situation, you need the approval to trade the options, the overhead to trade options. You need money. Options are very expensive. But imagine the aluminum was, say, $200 lower short time ago. So it would have more than compensated any premium paid. We use this counterfact analysis to understand how things work. We stay in touch. See you.